So a couple of days ago, Charlie Munger sat down and answered questions for 2 hours for the Daily Journal annual meeting, and just after that, I posted a video with some of my favorite clips from that interview. However, I was unable to fit all of the clips that I wanted in that single video, and since that video was so well received, I thought that I would do a follow-up with some extra clips from that 2-hour meeting, covering some of the other parts of the interview that I thought were really valuable for retail investors like us to understand. These kinds of videos take a long time to put together. There's a lot of prep that goes into these videos, so if you do get some value out of it, I would very much appreciate it if you could go below the video and leave a like on the video, and make sure you stick around to the end because I will be announcing the February giveaway winners. But with that said, let's jump into the first clip.
Do you think value investing is still relevant? And what about passive investing?
Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock. And that approach will never go out of style. Some people think that value investing is you chase companies which have a lot of cash and earn a lousy business or something. But I don't define that as value investing. I think all good investing is value investing. It's just that some people look for values in strong companies and some look for values in weak companies. But every value investor tries to get more value than he pays for. What is interesting is that in wealth management, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity, absolute insanity. I find it much easier to find 4 or 5 investments where I have a pretty reasonable chance of being right that they're way above average. I think it's much easier to find 5 than it is to find 100.
In this first clip, Charlie Munger tackles a couple of key investing principles or key investing areas. The first is what he defines as value investing and how you should be thinking about value investing when you're looking at businesses to invest in. And then the second part is in terms of his ideas on diversification. A lot of people define value investing very, very narrowly. They put it into a category where you're looking at businesses that have to have a really low price to earnings ratio and or a low price to book ratio. And of course, a business that has significant growth and that has a PE of say 25 or 30, that is always going to be a growth investment and is never a value investment. But Charlie Munger doesn't actually see value investing in that way. Similar to Warren Buffett, he defines value investing much more broadly to include all kinds of investing where you're trying to get more value back than you put out. And what he essentially means by that is that you outlay cash when you invest in a business, and you should be running calculations in order to estimate how much cash is going to come back to you while you hold that investment. And this way of looking at value investing broadly means that you're not limited to looking at businesses that strictly have low price book, low price earnings. You can look at businesses that are priced higher relative to their current earnings, as long as the future growth of that business, the higher future expectations of growth are reasonable. So for some businesses, 10% per year growth over the next 5 years is very, very reasonable because of their dominance in that market, or maybe because the industry is growing at a huge rate. Whereas for other businesses, a 10% per year growth rate over the next 5 years is something that may be very, very challenging to achieve because maybe it's an industry that is not growing, or it's an industry that's even shrinking over time, or just an industry that is very, very competitive. He then discusses his opinions on diversification, and in classic Warren Buffett or Charlie Munger style, he thinks that diversification as an active stock picker, as an active investor, is not something that you should seek out. He thinks that, well, as he said, it is much easier to find 5 really good investments, 5 really good businesses, than to try and find 100 good investments. A lot of actively managed funds at the moment will have portfolios with 100 stocks, 200 stocks, 300 stocks, or even more businesses in their portfolio. And these are portfolios that are actively managed, meaning the manager is looking at these businesses and choosing which ones to sell down or trim and choosing which ones to add to. And if you're managing that many businesses, first of all, if you go that broad, then your return is likely going to be very similar to the market. So why not just invest in the market and reduce all of those expenses related to actively managing the portfolio? But the other thing is, if you're looking at 100 different businesses, your time and research is split between many of them. And of course, some active fund managers, a lot of active fund managers have big research teams behind them, but the best funds that operate actively have one active manager and they're investing in a small number of businesses because they are focused on which investments they're making, and they're very, very selective, and they make sure they only invest in businesses they are very, very confident will make them money over the long term.
Charlie, you actually got a couple of questions from shareholders about Bitcoin, and he asked if your opinion on cryptocurrencies has remained the same, and would the Daily Journal consider Bitcoin or any other cryptocurrency as an asset on the balance sheet, similar to what Tesla recently did?
No, we will not be following Tesla into Bitcoin. Bitcoin reminds me of what Oscar Wilde said about fox hunting. He said it was the pursuit of the uneatable by the unspeakable.
In this very brief clip, Charlie Munger again reiterates his opinion on Bitcoin, saying that he views it very much in a similar light to gold, in that it's a non-productive asset, right? And when we're saying a non-productive asset, what we mean is if you buy gold or you buy Bitcoin, besides being able to sell that to someone for a higher price or a lower price or the same price, it doesn't do anything in the meantime, right? And that's different to productive assets like, say, a property or a business, where if I don't sell my property, if I buy a property and I can't sell it for some reason, I can still do something with it. I can rent it out, right? Or if it's a block of land, I could put a farm on it and I could grow things on it, right? Assets that can do something are called productive assets. And those are assets that Charlie Munger and Warren Buffett are much more interested in. They want assets that produce cash flow, and businesses also fit into that category. It's also a lot easier to calculate the value of a productive asset compared to calculating the value of something like gold, because the value of a productive asset is the cash that it can produce and return to you, which makes perfect sense, right? You're buying an investment to get something back. So if I'm buying a property and I can figure out exactly what I can get back from that property through renting it out and generating cash flow net of my expenses, then I can figure out exactly what it's worth. And the same thing is true for a business. A business that produces profit has a network of people and buildings and machinery and all of these different things and customers, and is all working like this big machine to produce cash flow and then deliver it to me. And in that way, you can easily, or a lot easier than other assets at least, it's not easy, but easier than other assets, you can estimate what its value is and therefore figure out what price is appropriate to pay.
BYD is in the Daily Journal stock portfolio with a very big paper gain. The stock has gained so much this year and last year. The stock appreciated probably way more than intrinsic value. How do you decide to hold on to a stock or sell some?
Well, that's a very good question. BYD stock did nothing for the first 5 years we held it. And last year it quintupled. And what happened was that BYD is very well positioned for the transfer of Chinese automobile production from gasoline driven cars to electricity driven cars. You can't imagine, it's in a wonderful position. And that excited the people in China, which has its share of crazy speculators. And so the stock went way up. Since we admire the company and like its position, and we have a tendency to, and we pay huge taxes to a combination of the federal government and the state of California when we sell something. And on balance, we hold in to certain of these positions when normally we wouldn't buy a new position. Practically everybody does that. One of my smartest friends in venture capital is constantly getting huge clumps of stocks at nosebleed prices. And what he does is he sells about half of them always. That way, whatever happens, he feels smart. I don't follow that practice, but I don't criticize it either.
In this clip, we get an interesting insight into how Charlie Munger approaches selling expensive businesses and how he deals with businesses that he's purchased that have now gone up in price, as well as what does he do if a business that he likes goes up in price. Does he continue to buy it at that higher price, or does he hold back and no longer buy? And Charlie Munger basically says that he is a buy and hold investor, in that if he buys a business, of course, when he's investing into a company, he's looking to buy them at a really, really cheap valuation. But if that price of that business, of that great business, then goes up and becomes fairly valued and then goes on even to become expensive, he will typically hold on to that business. And he quotes tax as one of the key reasons for that, but he also justifies it through wanting to hold on to really great businesses over the long term, even as their prices rise. He also talks about one of his venture capital friends who tends to take half of the investment off the table so that if the stock goes down or the stock goes up, he wins either way. And he says that he doesn't have a problem with that. Personally, it's not the way that I go about it, but I know that a lot of people do a very, very similar thing. Maybe not taking half the investment off, but a lot of people, if a stock goes up significantly, will take out their initial investment so that whatever is left, they are just kind of playing with the profits, and that way they won't feel bad if the stock ends up going down. And there's no definitive way that you should be approaching that part of analysis. In many ways, the way that you should approach it should be to align your emotions to not be triggered in the markets, because one of the biggest reasons why you will fail as an investor is you will let your emotions drive your decision making. So if taking off a little bit of your, taking out your initial capital that you initially invested, or selling half of your investment, if that makes you a lot calmer about your investments in the market, then that may end up being the best strategy for you. There's no real definitive way that you should go about it in this circumstance. Personally, I lean much closer to Charlie Munger and Warren Buffett in that I'm a buy and hold investor. So even if a stock for a really great business goes up substantially over time, I'm very unlikely to sell that stock unless it goes up an insane amount to a bubble level. In most cases, I'm just going to hold on to that business and then wait, and hopefully it gets cheap again so that I can stockpile and add more to that investment.
Do you think it's best to invest in the common stocks of businesses early while they are more nascent and the industry is smaller, or wait until they are the clear winner of a more mature industry?
Well, I think Warren and I are better at buying mature industries than we are at backing startups like Sequoia. The best venture capital operation probably in the whole world is Sequoia's, and they are very good at this early stage investing. And I would hate to compete with Sequoia in their field. I think they'd run rings around me. So I think for some folks, early stage investing is best, and for other folks, what I've done in my life is best.
In this clip, we get an interesting discussion around what types of businesses or what size of business you should try and focus on finding. Charlie Munger says that he has built his wealth on finding really established larger businesses, mature businesses, but he recognizes that other people are very good at picking businesses at different stages, right? That's his area of expertise, but it doesn't necessarily need to be your area of expertise. There are certainly people who are very, very good at picking out businesses at a very, very early stage. And when they're investing in early stage businesses, they may invest in 30 of those early stage businesses, and then they're hoping that one of those goes on to become a really, really successful business. Whereas Charlie Munger has kind of a very opposite approach to that, in that he is finding businesses that are already established, already mature, very, very predictable, and then only buying a few of them, being very confident in the amount of cash flow those businesses can deliver to him. But that's all the clips that we had for today. I hope you guys enjoyed today's video, and I'd love to hear your thoughts down in the comment section below. Now, as I said at the start of the video, I will be announcing the giveaway winners. So the giveaway winners will be on screen right now. If that is your name on screen, then congratulations, you have won yourself a free copy of the Essays of Warren Buffett, which is my personal favorite investing book. It consolidates a lot of Warren Buffett's teachings over the years, over the past 50 years, really. And it is just a fantastic book. So I'll be reaching out to all of you via email in order to send those out. So congratulations, and thanks everyone else who also entered into the competition. But with that said, I hope you guys enjoyed today's video. Leave a like on it if you did, and hit subscribe if you want to see more content like this in the future. But with that said, I'll see you guys in the next video.